Well, good morning, everyone, and welcome back. It's Monday, November 25th, and it's Thanksgiving week. That means we're expecting less volatility, less trading action, less news, less of everything. Usually, not always, but typically during a holiday week, whenever a week is shortened, either by having a Monday off or a Friday off or Thursday and Friday off, and especially big holidays like Thanksgiving and New Year's. Thanksgiving is the biggest traveled holiday of the year. So I'm expecting very muted trading action. All the Fed data has moved up. As you could see, all the data that comes out Thursday and Friday comes out on Wednesday. Although I believe the market may be open. I'm not even sure. It may be open part day on Friday, but I'm telling you right now, Thursday and Friday is dead. Forget about financial markets. Enjoy your turkey with your family, okay? I'm not kidding. I'm serious. Don't look to do any short-term trading on Thursday or Friday or even Tuesday or Wednesday. Subdue trading action. But with that said, we have GDP. We have the quarterly GDP coming out on Wednesday and jobless claims. Those are the big numbers for the week. Now, GDP consensus is 1.9. Last time, it was actually 1.7, but it was revised to 1.9. Consensus 1.7 to 2. If we can get a GDP of 2, that's going to be very bullish for the stock market. I'm not going to lie to you. GDP less than 2, bonds may rally as a result. Why? Because the Fed target for growth over the past year has been about 2%. And they've been fairly much on target, except for a few times where we were 1.7, 1.9, and a few times we went over 2. But the consensus is 1.9. Again, anything below 1.9, bonds may rally. It's telling us the economy may be slowing down just a tad. Not a lot, just a tad, nothing to get worried about. But anything at 2% or over, that means there's a good chance we may see a minor rally from the stock market. I don't think we're going to see a huge rally because stocks are overbought. Again, why? Global tension. Nothing has been resolved. If you look at the S&P 500, we peaked out beginning of last week. We were grossly overbought. We're now just beginning to come off overbought territory, and I don't believe the market's going to head higher unless there's a catalyst. We need a catalyst right now. Earnings, bye-bye. We're done with earnings, and they didn't shine. They were better than expected, but remember, the expectations have been beaten down to death. So we're not seeing a lot there. If anything's beaten down enough, obviously if the number is not so bad, it'll be better than expected. But in terms of growth, this year, we're not doing that well. Next year, we're expecting earnings to be about 10% better than expected. So 2020 should be a better year for earnings. Again, the key index that I'm looking at right now remains the Russell. Till we see the Russell 2000 trade continuously above the 160 level, continuously, meaning for a week or two, upside action, we need to break this. Let me show you. We got to break this level right here. This is a 1-year chart. Look at a 2-year chart right here. We got to trade back towards these levels. So we have to break this level here, the 160 level, and begin trading higher. The fact that the market is consolidating right now, it's not a bad thing, and it's better than it going down. But again, I don't believe until we resolve China, or not till we resolve China. I believe till there is a indication on the horizon that the probability of us resolving China is better than 50%. Right now, it's like 10%. I believe Russell will start moving up. Why? Because the Russell's speculative, and it tends to anticipate things ahead of time, just like this. We anticipated China, and the market crashed way before the S&P did. Remember, the S&P just made a new all-time highs just a few days ago, right here. Small caps, still stuck. So this is going to help propel the market higher, not the large caps. There's not that much China in the large caps in terms of fear, but small caps still have it a lot. Now, if GDP and if the Fed data that's going to start coming as early as tomorrow, Jerome speaking today, if Jerome Powell is the head of the Fed, if he keeps saying economy stable, that's not a big catalyst for the stock market because we already know everything. So tomorrow we have new home sales, consumer confidence, manufacturing index, International trade, which is not going to be pretty, I can tell you that right now. But these reports, don't look at whether they're good or bad. Look to see whether they're better than the expectations, the consensus. The consensus is what you want to look at because the market is pricing in the consensus in real time. So if we're above the consensus, that's good. If we're below consensus, that's bad. Now, something interesting. The bond market, even though the stock market has been stable, more or less stable here, bonds have been rallying in anticipation of a cool-off in the economy and a cool-off in large caps, small caps, and more likely than not, nothing working out with China and U.S. over this current negotiation period. And I think this is the 15th that we've had, and it hasn't amounted to anything. We haven't even gotten to phase one. We got to get to phase one, folks. Now, let me tell you some positive things, all right? This weekend was a stock big cap stock companies decided to go on a shopping spree. Remember yesterday on Friday, I told you that one of the 3 top stocks was Tiffany's, and usually when stocks are making all-time highs or near all-time highs, they're takeover candidates. Now, I told you Tiffany was a great investment on Friday, and guess what happened overnight? Louis Vuitton bottom for $16 billion. The stock is now up $7 pre-open. I told you guys about this Friday morning. You had 8 hours to get in. I had no idea Louis Vuitton was going to buy it, but I really liked Tiffany. All you have to do is look at Thursday's or Friday's video, and I talked about it. I explained how it's making all-time highs. It's bucking the trend in retail, and it's looking really, really good. And this morning, takeover candidate. All right? That's one, but that's not it. That's not it. Schwab. Charles Schwab and TD Ameritrade. All right. Now, this was totally unexpected. I did not see this coming at all. Charles Schwab is going to be buying TD Ameritrade for $26 billion. So this is positive. Whenever you have consolidation in the stock market, whenever you have takeovers, that's positive. Usually that doesn't happen in a bear market, and I'm not suggesting that we are in a bear market. What I am suggesting is that we still remain in a fragmented market. And I explained this to you by showing you some of my filters last week. Let me go through them again. This is really important, otherwise I wouldn't be staying on this forever. These are the top 10 sectors. And technology. Notice technology is leading. Consumer discretionary still in 8th place. It was in 9th place. Now it's in 8th place. But you see, consumer discretionary is a speculative sector. Consumer staples is very, very defensive. Same thing with utilities. You have consumer discretionary underperforming consumer staples and utilities, but technology, which typically goes hand in hand with consumer discretionary, is totally out of whack. The market remains fragmented. Real estate was, I believe, the top was in the 2nd or 3rd spot. Now it's in last spot. So markets are fragmented, and we're in a holiday week, as you can see here. Don't expect too much from the stock market, especially as tomorrow and Wednesday. Expect subdued volume, expect subdued trading action. No, I'm not being a grim reaper. I'm not telling you the stock market's going to go down. I am simply anticipating. Let me show you what I'm anticipating so you could see it visually. I'm simply anticipating the S&P 500 to move to the 200-day line, which is right here, 292, giving us a nice pullback that will integrate all the sectors. So these sectors will become in line. They won't be fragmented like this, kind of moving in their own little world. And hopefully that'll subdue the bond market. The fact that bonds are rising when the Fed told us there is no plans to lower rates last week is worrisome. All right, that's a red flag. So again, the Russell's going to give you the best indication of what's to come, followed by downside in the S&P, which I believe will happen gently, or at least some consolidation in the twilight zone between the 50 and the 200-day, right around the 300 level. But one way or the other, we're moving lower. I'm expecting volatility. This is the VIX index. I'm expecting volatility to rise from about 12 to about 20 as the S&P comes down. And I'm expecting the bond market to continue moving higher, possibly after this week. This week is a good week to stay defensive and to do income spreads, iron condors, bear call, bull puts, that kind of stuff, and stay defensive and stay away from large cap stocks. Now, I just revealed a way to trade the most overlooked and explosive stocks in the market. I'm talking about stocks. I'm not talking about options. Usually when I talk about 123% gains, 135% gains, 90% gains, I'm always talking about options. But can you imagine making 135%, 123.30%, and 90% from a stock? Yes, a small stock, but a stock. Odds are you're completely and totally ignoring these stocks. I'm actually looking at them right now. And it probably has to do with their reputation for being risky. But I'm going to show you in this training, there's a correct way to trade these stocks. Click the link below this video that you're watching right now, learn all about it. And get this, unlike 99% of all stocks out there and securities out there, they're completely uncorrelated to the stock market. They have zero correlation to the stock market. And I'm not talking about bonds. I'm not talking about commodities. Normal stocks that you trade at a US stock exchange that have no correlation with the stock market, where you can make 135%, 90%, 123%. There's a ton I need to tell you about these and how to trade them. But instead of me doing it now, I created a full-on video, total instruction mode. You'll learn everything you need to know on how to trade these stocks. Click the link below. The training is coming down soon. Don't miss out. Follow the link below this video. And by the way, if you guys want to see more of these videos, I'm now posting them to Facebook, Wealth Press. Just go to Facebook, Wealth Press. You'll see them there early, or go to the Market Geeks YouTube channel. I'll talk to you guys later. And by the way, again, don't forget to sign up for this training, all right? If you want to learn how to make triple-digit gains with stocks that are not correlated to the S&P 500, that are not correlated to the Russell, that do their own thing, watch this video. Click the link below. Have a great week. I'll talk to you tomorrow. I'll keep you up to date with everything, and expect a slower week than usual. Talk soon, guys.